Okay, so good morning, everyone, and I warmly welcome all of you on this morning webinar, Saturday morning webinar. Uh, I know this is going to be very interesting, and we are all waiting for this session for last few days. We are living in a highly unprecedented time. This is unprecedented in all forms we can probably imagine. And the most talked about thing or the most worried thing in this time besides health has been our salaries, right? Our money we have, livelihoods we have. So Chandigarh University has uh, brought so many opportunities for all of us to learn in terms of our skills, in terms of our professions, in terms of our careers. And this particular opportunity, this particular session is another learning, but in a different way. So it's often said that most of the people worry about how much they earn, but actually what they don't know is what to do when they have earned, right? How to manage their money. So this session is precisely on those lines, in which we are going to discuss and learn how do we go from a hard working rat race kind of life to a financially freedom fulfilling life. And to discuss these things and to enlighten us on the journey towards that success, we have a very esteemed speaker, author, and guest of the day, Mr. Manoj Arora. So, sir, I welcome you warmly on this webinar session, and I appreciate and thank for joining us today. Before I go to the discussion agenda, let me just share a brief about sir. So, as many of us know already, he's a renowned author on financial and management domain and topics. But he was not an author when he started off. He was he started off as an IT professional, like most of our students do these days in engineering. And just to share a brief about sir, so by profession he's a IT engineer, IT professional, and a gold medalist from Aligarh Muslim University, from where he graduated in early 90s. And thereon he worked in L&T and consistently performed among the best of people there. Moved on to IT, worked in top companies like TCS, IBM, and again adapted that IT life and was able to come to the top elite of those companies. But then we say we have our inner call, and sir's call came that way, and he thought he's meant for doing something different, something more bigger than what he was doing. And of course stuck by the same feeling what most of the professionals are at one point of their career, in which they feel saddled and bogged down by the pressures of their jobs, and still not seeing light at the end of the tunnel. So he picked up a domain which most of us actually don't we probably fear, I would say, and started writing about financial aspects, financial planning, financial uh, planning of our personal and sort of career. Then he explored these areas more deeply and authored bestseller books in that area. Uh, Most read among those book which came in 2013, From Rat Race to Financial Freedom, Journey from Rat Race to Financial Freedom. I read that book a couple of weeks back, and I was really amazed by the depth of understanding and simplicity of language by which it was explaining the concepts in which how do we manage our money, how do we plan our financial life. So with this context, we have this opportunity to meet him and listen to him today, and we really hope that post this session we would have known much more about our personal finance and our planning than we know probably right now. and it would help us in becoming more wiser in the way we use money, the way we invest for ourselves, the way we plan for ourselves, and definitely help us plan a fulfilling and enriching journey for our careers. And definitely, as the topic said, we expect to know the secret to become a millionaire by a passive income stream. So on this note, I warmly welcome all the audiences who have joined us. I appreciate your effort and time to join us, and I warmly welcome the guest of the day, Mr. Manoj Arora, on this talk. And we really look forward to listen to you and know more about this area. Over to you, sir.
Thank you, Dr. Pawan. I think it was a wonderful introduction. So I think while we go through the slides, I think one of the things which you talked about, which I really liked, and which is the core, is simplicity. A lot of people think finance is a very complex subject, but then over time I realized that if we do the simple things right, then it's no more complex. And then but the biggest challenge people face is to keep doing those simple things over and over again. That's the biggest challenge people face. So today when I present, I'm going to tell you certain very simple things which, if you adopt at this age of your life, when you're just probably in college or passing out of college, if you can adopt those simple things, but if you can continue to do those things over and over for the rest of your life, I am sure you'll end up with enough wealth, more than enough wealth that you need for your entire lifetime. So we're going to touch upon certain myths that we have. We're going to touch upon certain basic wealth management principles which are time tested, followed worldwide by most millionaires. So we're going to go that way. So I'm going to start with my presentation, and while I talk, you can keep noting down certain points which you feel are important or which you feel you want to ask. We're going to have uh, right, Dr. Pawan, we're going to have a Q&A session in the end, about 15 minutes or so.
Yes, definitely. They can anyways post the questions in between also in the Q&A link, and we will take all the questions towards the end.
Okay, fair enough. So you help me coordinate that Q&A section later on. Okay, so let's get going straight away. We are already 300 plus participants. We are already 10 minutes above time. So I'll just start sharing my presentation and then talk you through that. So I hope the presentation is visible now.
Yes, it is visible, sir.
Okay, great. So as Dr. Pawan already talked about it, I have spent around 20 years working in various Fortune 500 companies. And then, as he said, the calling took me, it attracted me, and it took me away from my standard, socially acceptable routine life. And then I moved into writing. I then moved into certain of my passion areas, which involved planting trees. So I founded a NGO by the name of Kalpriks, and we have been active for the last 2.5 years, planting more than 3,000 trees and actively taking care of them. So I'll not spend more time in introduction. So these are the two books which Dr. Pawan talked about. One is the Financial Freedom book, and another is the Autobiography of a Stock, which is the latest one on the finance side. And then there are certain other books which are on the non-finance side, which is Happiness, Dreams, and book on parenting, which is A Father's Diary. So, because it's important that you connect money to life, because otherwise money is a dead element. So that's why in my writing also you would see in all the books, it's not only about money. You have to connect it somewhere to your life. It has to serve some purpose in your life, and it can help us do a lot of good things in life. And that's the whole intent of writing books on multiple topics. Okay, so let's move on. So we're going to stick to this agenda. They're going to be basically 3 sections. Section 1 is where we'll understand what is wealth or what is financial freedom. I think this is a topic. Financial freedom is a topic which is quite well known in today's generation, but then there are a lot of myths surrounding it. So we're going to go to section 2, where we'll kind of try to break certain myths around finance. There's a lot of myths, and people feel it's very complex. People feel younger people should not get into money aspect. They should focus on study and all that. So a lot of myths are surrounding that, which we'll try to uncover. And then we'll talk about the basic principles which all of you should adopt in your life starting today. And it's very simple, very doable, but the challenge is to do it consistently. Okay, so it's always like this. A morning walk is very simple, very doable, but the challenge is if you can do it for 10 years at a stretch, 20 years at a stretch. The challenge comes in consistency. And if there's a strong goal which is driving you, it's not difficult to be consistent in that case. Okay, so let's move on to section 1. We're going to talk about wealth. We're going to understand a few terms. We're going to talk about financial freedom. We're going to again understand a few terms. And we're going to go to very, very basic, very simplified version of things so that you understand it. And if you understand the simple things well, you have a very strong foundation with you. And then you can build on to it yourself as well. You don't have to depend on anybody on building it once your foundation is strong. Okay. So let's go on to section 1, where we're going to talk about certain basic aspects of wealth and financial freedom. So, we have been running a lot of races. So, rat race is something which a lot of you are aware of, but there are many other races which we are running today. Okay. The first race that we hear about, we listen about every day in the news is what? Is the global race for economic growth, right? Everybody is racing against each other. Every country is racing. Okay, India is growing at 5%. Okay, how much is US growing at? How much is China growing at? Okay, so it's a competition. So if our rate of growth falls, then there is a concern. There is a political fallout. There's so many things happening around. So there is a consistent race for the countries to grow. And what has happened in this race? The end result of this race is our planet is suffering, Earth is suffering, right? All of us are suffering because of it. So the races which we all are guilty of running, the first race is the global race for economic growth. And you hear about so many countries, but would you have you ever heard about these countries when we talked about the race for economic growth? Countries like Finland, Denmark, Norway, Iceland, Canada, maybe Canada a little bit, Sweden, Switzerland, Austria. Now, these countries you don't often hear about because these countries are out of the race. They are the happiest countries in the world. And when you are in the race, obviously you cannot be happy because you're always worried, you're always competing, and there will be times when you will fall behind. So your happiness is lost there. So that's the fallback of running an economic race that each country is, guilty of doing. Forget about this race. What is the race which you guys are running today? So you're running an academic race. That's also a race. Okay. How many times you've heard your parents talking about, okay, my child got this much percentage. What was the percentage of your child? He got admission into a particular college. Where did your child get admission? And there is a race even in the brand of the college in which the students get admission. So we all talk about results. We talk about college qualification. Okay, somebody is graduate, somebody is postgraduate, somebody is doctorate. So there's a race even there. So it's always considered superior that if there is a doctorate versus a simple graduate. Okay, what's your first salary? Okay, what's your company you're getting? The brand of the company. Somebody is getting into a brand like L&T or brand like IBM, while somebody is getting into a slightly unknown brand but is loving his job. But then the race would make him uncomfortable. So this is another race we are all running of. So rather than talking about results and brands and all, we should be talking about efforts, how to put in good efforts, how to put in satisfying efforts, how to handle failures. This is what we should be learning rather than what we are learning today. What are the values we hold? How do we connect with God? How do we elevate the world? These are the kind of races, if you ever wish to participate, this is where you should be competing rather than the above which is shown here. Okay, and then the most famous race that we are all guilty of running after we pass out of college and move to various companies. Some may go for post graduations and doctorates, but some would obviously join certain companies. And you would be guilty of running a corporate rat race. Not that you want to do it, but then you will have no choice. You will have you will land up into an environment where everybody is already running, so you'll have no choice but to run along. And there will be a few exceptions who would want to quit that race and do something drastically different in life. I tried that. I'm still trying, and trying to do a lot of different things and things which satisfy me. And there will be people out of you who would also want to do that rather than just running the race which we are all running today. Okay. So in a corporate rat race, typically you will talk about competing about which company somebody works with, how much salary he or she gets, what's the kind of growth, what's the gadgets and cars the person is holding, what kind of house. So, these are typically what we discuss in our circle. And this is what gets into a race. And it's very difficult to, break that cycle and come out of it and do something drastically different, because socially it becomes very difficult for people to accept if you're doing something drastically different. And we are so many times driven by what society wants us to do. So it's a race. Some of you should definitely come out of it and talk about things like, how do I balance my work and life? How do I have more integrity at work? What about my children's dreams? What about happiness, my purpose of life, family time, God? So many things which we should be working on. But unfortunately, we are stuck into a race which talks about salaries and growths and cars and so on and so forth, and very less about the other things which are far more important in life. Okay. So I think I'm going to show you a graph now. And it is very important for you to understand this graph. It's a very simple graph. And if you understand this graph and keep it in your mind for the rest of your life, you would know what is more important. You would know how to get there and where to get and where are you currently. So look at this graph, and I'll pause in after showing you the graph. I'll pause for 10-15 seconds and try to give you time to really understand what this graph depicts. So don't go by the simplicity of the graph. Try to understand what it is depicting. Okay, so this is the graph. So on the y-axis, you see free time, okay, or available time, and it grows from 0 to goes higher. And on the x-axis, you see money, which goes again from 0 to higher. And it's a very simple graph listed there. So I'm pausing in for 10 seconds. Just think through what all it is depicting. It's not only one thing, there are many things depicted in the graph. 10 seconds. Okay. So the first thing which you would see in the graph is the aspect where you actually start earning money. So if you're just going out of college and trying to get into a job, this is where you are. So all of us at some stage of life are at this stage where we have a lot of time. So we have all the free time in the world. We can go to any company and start working. But we don't have money right now. So the money component is very less here at the first stage. And then what do? We go to a job, or we start any business or any enterprise or anything that we start doing. We are essentially trying to trade off our time with money. So we're saying, okay, take my 8 hours, take my 10 hours, and give me, let's say, 10,000 rupees. Okay. So just to give you the aspect of it, that it's basically trading. I am ready to trade off my time and earn some money. And obviously, earning money is important. Nobody denies that. But remember, you're trading off your time, and time is what you have extremely limited in your life. You will, at some stage of life, you will have enough money, but you would be stuck in a race where you will not be able to come out of it in spite of the fact that you have enough money. So that's what I want you to be careful about. I don't want you to not have money, but you want to be careful about when you have enough money. Okay. So we all start earning money here, and we start giving off our time. So our free time becomes less as we go along the curve. and we start having more and more money. And there comes a stage. This is the second stage of this graph. This is the stage where most of the people in their 30s and 40s would stagnate. They would stay here and continue to stay here almost for the rest of their life. Okay, this is what happens. So this is the stage. Most people are stuck here. They have given up almost all their time to earn a moderate to fair money. Okay, money is good, not very good, but it's good. But they have lost all the time, and they're stuck in the race because it's a competition. Okay, so you want to come ahead in the race, so you people try to invest more and more time to earn more money because they've understood you to invest time, you earn money. So, but again, time is limited. So you cannot invest beyond time. So your money is also going to be limited. So most people get stuck in this section of the chart where uh, somebody's having a little more earning and spending a little more time. Somebody's having a little less earning, but they're all stuck here. What they do not know is there is an option to quit this race and take the curve ahead, which takes you here, somewhere here, which is where financial freedom is. And what it entails, what does financial freedom entail here? It entails that you have enough time and you have more than enough money. Now, this is the combination which you should be striving for. Of course, you have to pass through this phase. You cannot have financial freedom unless you start working. But don't lose the bigger picture. Don't get stuck in this you. Don't get stuck at the bottom of the curve where you have just moderate money and lost all your time. Because at some stage of life, you will realize that I've lost time and time was more valuable. Okay, so you got to earn it back. And the way to earn it back is to move from the bottom of the curve to and then move to the extreme right of the curve, which is where financial freedom lies. So we're going to talk about a few principles which if you follow, will help you reach financial freedom. But there are a lot of people we are helping today who are here at this bottom, losing all their time, earning moderate money, and we're trying to help them get back time and earn more money. Okay, so that's the basic aspect of the rat race at the bottom of the curve and the financial freedom at the top right of the curve. On the left side, when you're moving and when you're doing a job and moving from the beginning of the curve to the bottom, you're earning active money. Okay, what is active money? Active money is anything which is earned by exchanging your time. Okay, trading off your time, that's active. Because as long as you're investing time, you're earning. If you stop going to a job, you stop earning. If you stop doing your business, you stop earning. Anybody has a shop, anybody owns any enterprise, they stop sitting there, they stop earning money. Okay, so you got to find a way that you move away from active money at a certain stage of life and move towards passive money. And passive money can be earned in a lot of ways. Okay, uh, if I mean, it's not about the money you're earning, it's about what your money is doing for you. That's where passive income comes into picture, and we're going to talk about that in a lot more detail as we move along. But this is where you should be striving. Of course, to earn passive money, initially you want to earn active money, because passive money is generated by the money you already earned. So first you have to earn. Of course, you cannot earn passive money without having any money with you. You know? So that's the whole picture. And keep this graph in mind always for the rest of your life, and you would know whether you are moving in the right direction or not. Okay, so I'm moving on. And if there are any questions, you can of course note down, and we can of course take it up later. Another aspect which, other than time and money, there's a third very critical aspect which we miss in our while we are browsing through our life, and that is the aspect of energy. And a lot of time we feel that okay, life is going good, I'm earning good, I'm 40 or 30, and this is how life can go along. But you're not taking into account another important aspect of life, which is energy. As you grow, you will start to have less and less energy, especially after 40s, let's say. And as your energy declines, your ability to generate active money will also decline. Okay, so that element becomes very, very important. So this is how typically it works in life. When you're young, you have time and energy, as most of you here on the call would have. You have a lot of time and a lot of energy, but you're broke today probably. As you grow older, you become an adult, you get married, you have children. And at that stage, around 30s or 40s, that's when you have all the money, you have almost all the energy, but what you've lost is time, and that's what you start missing. You start missing spending time with your children, you start missing spending time with your parents. Those are the things which you start missing as an adult. And we're currently not understanding the aspect of energy here, because we still have energy at this age. And as we grow old, we might have all the time and all the money that we need, but we really lack is energy. And that is the aspect which I want you to focus on. And what we do in financial freedom is we take the money which an adult would have, we take the energy that an adult would have, and we take the time that somebody young or old would have. So we want a combination of time, money, energy, all available to us together. And that makes financial freedom, time plus money plus energy, different from retirement. Financial freedom is not retirement. Retirement is when you don't have the energy to actively pursue your passions or a lot of other things in life. We're talking about giving you time and money at the stage of life when you have the energy with you. At that stage you should have the time and money, because that's when you can utilize both your time and money the best. Okay, so this is how. Do not confuse financial freedom with retirement. These are very, very different things. A lot of people feel that financial freedom means, okay, I've retired, I'm at 60, I have enough money, I have time also now, I can spend with my grandchildren and all. But you don't have the energy, my dear, to spend that time and money in an effective manner with the people you love the most, or for your own self. Okay. And so a lot of people plan for international trips, and we'll roam around the world and we do this and that. But by the time they reach their 60s, 65, they don't have the energy to do all that. So you should be looking at achieving financial freedom, which means you have the time, you have the money, you have the energy at the age of, let's say, 40. Okay, that's when you have 20 years to fulfill your passion, you fulfill your dreams, do things which you always love doing. Okay, so that's what I want you to understand, the difference between retirement and financial freedom. Okay, so just think through your mind, and just try to list down the top three things that you would love to do if you had time, money, energy, all three put together. Okay, and of course this is not a interactive face-to-face session, but just list them down. It will really help you at some aspect of life to find out your passion, to find out what you really love in life. It'll really help you when you reach that stage. But list them down. It could be anything. It could be somebody wants to be a singer, traveler, scuba diver, environmentalist, a writer, sports person, anything that you think you want to do in life, but you got stuck somewhere. You don't have the time to do it, you don't have the money to do it, or you don't have the energy. Probably at this stage you have the energy but and the time, but you don't have the money to venture into these fields. You may love them, but you don't want to take that risk. Who is going to earn money if you really want to be an let's say blogger? It's going to take maybe in years to start earning good money. And how am I going to be acceptable socially in our country, or how am I going to be uh, feeding my family if I'm going to do all these things? But note them down. When you reach financial freedom, your objective is not met just by reaching financial freedom, because financial freedom is just a means, to to achieve these things which I've listed here. Achieve your passions, achieve your interests. Because once you have reached financial freedom, then you can be anything, because you don't want money from that thing. Okay, you want to be an environmentalist and go and plant trees around, you go and plant, collect donations, go plant. You don't have to earn anything out of it, because you are financially free, you have earned enough. Okay, so that's how it's very, very important that you strive towards freedom at a young age and do something meaningful with your life. It could be for the society or it could be for yourself, doesn't matter. but do something which really excites you. Okay, so that's very, very important. So what's stopping you today from achieving whatever you want to achieve in life, what we listed in the last slide? So either you don't have money, or you don't have time, or you don't have the energy. So these are the things which are stopping you. And who is going to help you? Who is going to help you get all these things? Only you. Nobody else can help you. It's only you who can help yourself get to these things, get to financial freedom. Of course, you would need guidance. Of course, you would need certain understanding, but nobody else other than you is going to help you pursue your dreams and passion. Don't feel victimized. There is a way out. You got to work hard. It's very simple. It's not complex. It's very simple, but it demands a certain level of discipline, commitment that we all need to put in to achieve financial freedom. Okay. So we talked so much about financial freedom, and so what if we have to define what is financial freedom in the backdrop of whatever we discussed until now? How would you define financial freedom? You may want to write it down somewhere in your notepads or wherever you are. But based off whatever we discussed till now, it's a very simple definition. It's a state where neither time, money, or energy are constraints. You have enough of all, just enough of all. It's not that you have unlimited money or unlimited time or unlimited energy. Of course, there is a constraint on time. You only have 24 hours in a day, but how much is available to you out of those 24 hours to do what you love doing? Again, you will have constraints of money. Financial freedom, some people can feel you unlimited money. Okay, I have every day on an international trip. That doesn't work that way. You got to plan for it, and you got to strategize it. It is possible if you plan that way. If roaming around the world is your passion, of course it can be planned that way. But you will not have unlimited money to just splurge around. You will have unlimited money to just splurge around. You will have more than enough to take care of your family, to take care of your needs, and then whatever you had planned in terms of your passion to do those things, you'll have enough money to do that. There will be no need to earn more money, although you can earn more money if you want to do. Okay, nobody's going to stop you from earning more, but there'll be no need. So you can focus more on your interest areas rather than doing something just for money, which you don't like that much. Okay, and again on energy, there's going to be constraints as you grow, but you'll have enough to do what you love. So today, if you ask me, I do all the things which I always want to do in life, whether it's having my own kitchen garden or vegetable garden, planting trees, writing books, spending a lot of time with my family, especially my daughters. So I think I do all those things, and I think I have enough of all to take care of everything and live a much more satisfying life than I would have if I was still working with IBM and continued working there. Okay, you're free from the compulsion to earn, though you can still continue to earn, so nobody stops you. And there are people who are actually with us in our unique program that we have, wherein they continue to earn even after being financially free because they haven't yet sorted out their passion in life and what they really really love, so they continue to earn money. And there's no harm in that. It's an added bonus in your life. Okay, and this is a state where you can do things which you love, irrespective of their money earning potential. And that's very important because most of the things that we love doing don't earn money for us. And we talked about all those things in the beginning, and they have a very low earning potential. But the fact of the matter is that when you love something, you become so good at it that after some time, that thing can potentially also start earning money for you. And if you continue to persist, it can earn so much money for you that you would never have imagined that earlier. So it's always advisable to choose a stream which you really love. But most often, I've seen people choosing streams where there's more job prospects or more money earning potential, and that's why you see most people moving towards IT and sectors which are really kind of have give you a lot of earning potential. Nothing wrong in those sectors, but it's just that it may or may not be your passion. Okay, you may just be going because you want to earn money, and end of the day you will succeed only in that stream which you really love. You know, that will not only be satisfying but will end up giving you more money, because you'll become automatically so good at it that money will never remain a problem. And this happens automatically because you love it so much that hard work is never a problem in such areas. And when hard work is not an issue, uh, then day night nothing feels odd when when you're working on your skill, and you become so good at your skill after a certain time that money is, it just starts to attract money of its own. And so it's very important that at some stage you move towards things which you truly love. So when you start moving towards the thing which you truly love, who pays for your monthly expenses? And those are paid by the money which you've already earned. So you've already earned enough money, you've already saved, and you've already invested that particular money in certain investments which you're going to talk about. And those investments, return you enough money which can take care of your basic needs of life, future needs of life, take care of inflation and everything else. Okay, you kind of become a CEO of all your assets when you call it. So we have not yet defined assets, but most of you may understand assets in general as any investments that you have done. It could be um, fixed deposits, mutual funds, stocks, real estate, anything. Okay, so those are your assets, and you become kind of a CEO of your assets, and they become your employees, and they start earning money for you. And that earned money should be enough to take care of all the aspects of your life. Of course, this would need a certain level of calculation and certain level of planning and execution and tracking, and so all those things will be involved. But on an overall perspective, it's your assets that start earning money for you. They become your kind of a replica. So you are spending time earning money, so they are invested in for a certain time and they earn money for you. So you put a 10 lakhs in a fixed deposit earning 10%, so then you earn 1 lakh after 1 year. So that 10 lakh has become 11 lakhs. So it is suddenly that 1 lakh has been generated by that 10 lakhs because you left it for 1 year. So your money started to earn money, more money for you. And that's how you start moving towards financial freedom. So you reach a corpus which can survive your monthly expenses, your inflation, future events, taxes, everything taken care of. And that corpus is your tipping point. And once you've reached that corpus, then even if you stop your active income, if you stop working, your money keeps growing still. So many people among in our program who are already financially free. So the corpus just keeps growing. If they're just spending money, they're not earning anything, but it just keeps growing. So because they've reached a tipping point, and beyond that, it's not going to fall down. Okay. Of course, you got to keep monitoring a few aspects and keep still tracking a few things so that it just doesn't get haywire at a certain stage of life. But then generally, that's how it works. So once you reach that tipping point, and that tipping point is different for everyone. For me, it could be 3 crores. For somebody else, it could be 4 crores. Somebody, it could be 2 crores. Invested in a certain way. Again, that way is different for everyone because everybody is different. Everybody's risk profile is different. Everybody's needs are different. Everybody's lifestyle is different. So it's not something which I can tell you, okay, if you have 3 crores, that's enough for you. Nothing like that. So it's every family is different, every person is different. So it has to be calculated for everyone. Okay. But once you reach that tipping point, you have achieved what we call as financial freedom. And this is the first time when you can be called as really wealthy, because that's when you don't have to work for money. Your money is working for you fully and supporting your lifestyle and taking care of inflation and everything else. Okay, so that's the point where we need to reach. Okay, so we move on. And when we say financial freedom, is it easy to achieve? Well, it's not complex, I would say, but easy in the sense that it demands a lot of discipline and commitment. So I would not say it's easy. Um, it's easy for someone who is already very disciplined and committed and have a very strong goal or a passion to go for. But for others, you need to inculcate those habits to get disciplined and get committed, and then of course it's going to be easy. So generally, no, nothing worthwhile in life is easy, and it's not easy to beat Sachin Tendulkar, but then is it worthwhile? Yes. So there's a lot of effort involved, yes, but then it is worth it. So the right question always in any aspect of life, when you come across, don't ask whether it's easy or not. Ask whether it's worth the effort or not. So don't be afraid of putting in the effort. Okay, let it be huge effort, but if it is worth in the end, then let's go ahead and put that effort. So is it worth it? Definitely, and it can give a completely different meaning to your life, as it has given to me and many other financially free people whom we have helped, get to financial freedom. It opens up host of opportunities. What kind of opportunities? So opportunities like you have a choice in life. You decide your day. Okay, you decide when am I going to work, when am I going to play, when am I going to enjoy time with my family, when I'm so you decide the calendar for your day every day morning. If you don't wish to work on a Monday morning, you don't have to. Okay, and a lot of people who are in jobs, I mean, you of course in college, as you move along to jobs, you realize that there's a fear of Monday morning, and the maximum heart attacks happen on Sunday evenings or Monday mornings. That's a uh, proven case study among the corporate world. And because people are stressed out, people don't want to want to go to office on a Monday morning, or even if they're working from home as we are doing nowadays, they they don't want to work in that environment, that culture of office politics and all. So they don't enjoy it, and when you don't enjoy something, it's going to impact you some way or the other. So it opens up a lot of opportunities for you. And if you ask me whether it's possible, definitely it's possible. Anyone can do it. Anyone means anyone. So even if it doesn't matter whether you're earning less, earning more, that's irrelevant. Okay, it all boils down to how disciplined you are, how committed you are, what are the sacrifices you're ready to make to reach that tipping point. Okay, so it's definitely possible for anyone. uh, I have interacted with more than 3,000 people I mean, I have interacted personally, I'm saying, with more than 3,000 people one to one who are seeking financial freedom. And for none of them, I would say, not even a single person, it comes out that it is not possible for you. It is possible for someone, it may be possible in 5 years, for someone 10 years, someone 20 years. That's a different thing because it depends a lot on how much you're going to save, how much you're going to invest, what's a lot of other factors. But it is possible. Okay, and that's a very, very big hope that I must give you, that in this lifespan you can be financially free, reach that tipping point, do what you love doing. So you don't have to really. A lot of people are confused. Okay, I have to quit my job to do something. You don't have to. You first reach financial freedom and do whatever you want to do in life. Nobody stops you. Don't quit your job. You don't. You can't put your family on risk. When you're want just to settle just to fulfill your own dreams. Okay, so there is a way out. You reach financial freedom, work for 5 years, whatever, 7 years, and then do what you love doing. Your family is secured. Okay, so it is possible. And as Bill Gates says, beyond a point, money doesn't impact your life much. So there are a lot of people who want to earn a lot of money. So beyond a certain point, I mean, of course, till you reach that tipping point, money is important for you, and you're going to have work hard to earn that money. But after you reach that point, and for him it's like first $1 million or whatever, then it's all about freedom. It's because this 1 million is important because you want to achieve freedom, and freedom is very, very important in life. And we talk about a nation's freedom, we talk about how vital it is. And similarly, your personal life, if you are not free, if you're still slave to your money because money is driving you, you got to earn. If you're still slave, then you really haven't really seen life. You haven't really enjoyed life. So it's very, very important that we understand how critical freedom is for us to enjoy our life. Who knows whether this is the next birth or not? If I'm not going to enjoy it this lifespan, I don't know what's going to happen in the next lifespan. Okay. And this is how your life's balance, gets impacted. This was my life's balance pre-freedom and post-freedom. I've just put in approximate figures from my own life. Earlier, I used to work around 12 hours a day, then 2.5 hours roughly to family, 1 hour to self, and if there's any time left, then probably spirituality, God, and everything else. But today, I see a more balanced life post freedom. I took financial freedom around 5-6 years back when I quit IBM and decided that that's not how my life is going to go. So post freedom, I see it's a very balanced kind of life, and the best part is there's no fixed hours. I can rotate them around in the sense that okay, the morning time for the family, the second half probably for the work, and work would mean something which I love, and then probably I would take on God, and then I will talk about self, and so this is how I decide how my life's going to really go day by day. If you have improved your day, you've improved your life, because again, life is a combination of certain number of days, and that's all about it. So it's very, very different. You have to really experience post freedom life, and once you've experienced it, then you cannot go back to pre freedom. You will never, because it's so beautiful, it's so different that you don't want to go back, even if it pays you more, of course. You don't want to go back. And so that's, I think, at some stage of life you should experience this. Okay, so last slide before we go to the next section. Who becomes wealthy? You got to have a powerful goal, strong discipline. You do not need any special skills. Very important. Okay, don't. I have no background. I mean, academic background, I would say, in finance. Absolutely no degrees in finance. I have no inherited money. Absolutely zero. Okay, I don't have any special skills on finance. Nothing is needed. It's very simple. Demands discipline, but it's not complicated. Okay, so you really need to focus on the right aspects, focus on your goal, and just keep moving ahead. Very simple things which I'm going to show you, the wealth management principles, when we come there. So whosoever learns and implements the basics of saving and investing money is going to get financially free. As simple as that. And trust me, this is not complicated. I'm repeating that again and again because people feel finance is complicated. It is not at all complicated. You got to plan for being wealthy with, of course, you got to be very precise in what you're doing. You got to have a monthly target, and the targets are derived based on certain calculations. But you got to be planning it well, you got to be executing it well till you reach that tipping point, and even after that you got to keep track of it. But it's worth it. Again, it comes down to doing all that. Is it worth or not? Yeah, if you can change my life towards a beautiful life, why not? Let me do it. Even if I have never done it, let me start doing it. Okay, so you should go and execute your plan with discipline, commitment. And for your information, there's something called the first generation millionaires. And if you don't know, 80% of American millionaires are first generation, which means they don't inherit anything. They just become millionaires of their own. And of course, what's the trick? There's no trick. I mean, you got to be disciplined, you got to be saving, you got to be investing, and you got to be monitoring it. So if you're doing all that, you will become financially free. There's no big deal in that. Okay, so we're going to move on to section 2, and we're going to break certain myths on finance. These are the top myths which I felt, based on my experience with a lot of financial freedom seekers personally. And these are the top things which they feel, I felt that there's a big myth here and it needs to be broken. So I'm just presenting you those top myths here. Okay. Okay. So here comes the first one. A lot of people feel that it takes a lot of money to make a lot of money, which basically means that's the typical feeling that you got to take a lot of money on loan, do some business, and then that'll help you generate a lot of money. Well, that's one way to do it, but that's not the only way to do it. There is a bigger lever than money to make a lot of money. Okay, so the fact is, it takes some money. Definitely, you need some money to make money, but it takes a lot of time to make a lot of money. People whom you see, there is no overnight success. For people whom you see as successful today, we just see them as suddenly they start appearing in newspapers and media that, oh, this guy has become really successful. But then we don't know how much of time he has been spending on his skill or her skill, and how he or she has really, moved along and following that area of passion of his or her, and have reached a stage today. So it takes some money and a lot of time. Okay, and what this boils down to is got to start early. Okay, how will you have a lot of time to make a lot of money? Again, everybody has limited time in life. Somebody starts to think about financial freedom or things like these at the age of 35. Somebody started thinking at the age of 21. So this guy who started thinking at the age of 21 has a 14-year advantage to the guy who started thinking at the age of 35. In fact, I was the one who started thinking at the age of 35. I knew I was late, but then you can't reverse time, so I had to start from there and then look forward in life and then move on. But if you have an opportunity, if you have the knowledge, if you have the awareness today at a younger age, and most of you are in college or just moving out of college, at that age, if you're aware of it, that time is critical aspect to generate money, then you would start saving and investing right now. Okay, I have people who are starting to save and invest even from pocket money, even if they're not earning. Okay, Warren Buffett started investing at the age of 7 years. Okay, that's the age when it started. Okay, so time makes a huge difference, and we know how big his wealth is today. So time is a very, very big lever. Make use of it, don't let it go. Once gone, cannot be recovered. So at this age, wherever you are today, make sure you get something out of today's session, start working on it, and get going. Start saving money. Saving is so vital. The first step before you invest is to save. It's very, very vital at this age. Even if you can save, you have a potential to save huge, but even if you can save 10%, 20% of your whatever you're going to earn, or whatever pocket money you get today, and learn how to invest a bit of it in certain assets, then you start on your journey. You have time with you now, and this money is going to grow huge as you move along. So this is the first myth I want to break, that time is vital. It's not the money that makes a lot of money. Second myth, a lot of people feel that earliest we can get started to accumulate wealth is when we start earning money, because unless I get into a job, how will I, save or invest? So that's a myth. And the fact is that earliest you should get started is when you know how to count. Okay, if you know how to count money, if you can do the basic calculations, if you can do plus minus multiply divide, if you can do certain basic things like interest calculation, that's it. You don't need any more specialized skills to earn, to save money and invest in basic assets. Of course, if you're going to invest in certain specialized assets like mutual funds or stocks, you'll need more knowledge. But then basic things, if you can just save that money and invest it, let's say a fixed deposit, very simple, simplest of all, you will start at least earning 5%, 6%, 7% on whatever you have saved. And it'll keep accumulating, it'll keep compounding, and we'll come to compounding how powerful it can become. And the key is to start at a young age. Okay. So don't wait for you to start earning through a job. You can start right now with whatever you have. Take 20% aside. Nothing is going to happen. You will still have a wonderful month going, even if you keep 10, 20% aside. But your money will start growing. That's the most beautiful part. And time will be with you. So make use of the time that you have right now. Take that advantage of time. Okay. You first need a lot of financial education to invest money. Again, a myth. You don't need any financial education to really know financial education. Basic mathematics is all you need. You just need fundamental school education, not even college education. Okay, if you know, as I told you, plus, minus, multiply, divide, interest calculation, formula usage, uh, the 10th class students are so smart nowadays. I mean, they can do all that themselves, and it's just that they need to be guided on how to do it, how to just put your money into investing and let it start growing, let it start generating passive income. A simple fixed deposit is also generating passive income, right? You don't have to spend time for that. You just put in that money and then it starts kicking off. Okay, so make use of the time leverage. Don't wait for any financial education or anything else. Okay. Next myth: teaching about money to children is not morally good, and that's what we see typically in Indian culture. And I'm so happy that in colleges we are organizing these seminars nowadays, and thanks to people like Dr. Pawan and the entire Chandigarh University, and it's very important that we bring these principles, we enlighten and we aware our younger generation. In homes, we should be doing it with our children. We should be teaching this in schools, and in fact, probably in next 1 month's time you will hear from me that we are tying up with a lot of schools at 10th or ninth class level, wherein we're going to have regular these kind of sessions with them. And it's so important that they learn at that age, because ultimately time is going to generate money, nothing else. Okay, so, and teaching to children is definitely there's nothing wrong in that, because ultimately you're preparing them, right? They'll grow big, they will start earning money. And I've seen so many people, even I've interacted with CFOs and CEOs of organizations. They have all the financial experience to handle their office, or the work they're doing. They handle their clients, but they do not know how to calculate an ROI of a mutual fund. They do not know, because of course it's not very simple. I mean, you got to have certain awareness to do it. Uh, Once told, a 10th class student can also be able to do it very simply, but then they don't know it. Okay, so they've reached an age of 30, 40, they're managing clients, handling worth millions of investments. They don't know how to calculate a return on a mutual fund or a stock. They don't know. And it's a fact. And so we don't want our children to land up in that situation. So we got to prepare them young. Okay, so if they're going to handle money in future, and everybody's going to handle money, it's not that somebody is going to be CFO to handle money. Whichever field you are working in, you're going to handle money, you're going to earn money, right? So you got to know how to handle it. So we're preparing them basically to earn it, and we're kind of in a younger stage. Okay, don't teach them, let them focus on studies and all that. Very important, focus on studies, good. You should focus, but then doesn't mean that you should not be aware at all about how money works. It's very, very important. Okay. Okay, this is another myth. People feel that if I earn income, let's say 100 rupees, and if I spend, let's say 70 rupees as my expenses, then 30 rupees are going to be my savings. If you're going to work this way, you're going to land up with very less money in your life. This is not the right equation you should be focusing on. What you should be focusing on is whatever I'm going to earn, first I'm going to save. Okay, and then whatever is left, we're going to spend that money. Of course, there are certain mandatory expenses in a month which we got to take care of, and there are certain non-mandatory expenses which we got to take care of. But then the focus should be the moment the salary comes in, or the moment the business income comes in, what's my saving target? Of course, you got to have a saving target for that, and again you got to plan for that. But you should be saving first and then spending it. Okay, so that's a very, very important myth which needs to be broken. Most millionaires live a lavish lifestyle. Another big myth. Okay, there's so many books which, if you read, will tell you that there are millionaires around you who lead a very, very simple life. They don't lead a lavish life. 85% millionaires in the world, they live a frugal lifestyle. You don't hear about them. You only hear about a few names, 5, 10, 15, 20. That's it. But how many millionaires are there in the world? You know that there are thousands and thousands of millionaires. So you don't hear about anybody else. They are living a very frugal lifestyle. Frugal doesn't mean that you have to be a typical conjuice, as we call it. Frugal just means you're not wasting your money. You're making sure that it's utilized the right way. Okay. Again, the idea is not to keep accumulating money. The idea is to reach a tipping point called financial freedom and then live your life. Okay, that's the whole idea about actually approaching financial freedom. So if some, I mean, you don't have to live a lavish lifestyle once you have money. You want to make sure that the money is used for the right purpose. Okay. Okay. Another myth: when you invest, you expect good returns. That's the primary driver of an investment. I've seen so many people. I asked somebody to, put certain money aside from his or her portfolio for emergency needs. They say, okay, but if I put that money in savings account, it will earn me less interest. Okay, but that money is not supposed to generate money for that money is supposed to serve you for an emergency. So good returns is not the only driver for an investment. It is important, but not the only thing. So returns are important, but just one criteria, and there could be many other criterias in your life which would, you know, need money. Okay, a lot of people feel that they're good investors are very smart. They keep moving money from one investment to another in search of fantastic returns. And we hear two, three names in the media, and we hear in the newspaper, okay, this guy has returns has been 1500%, kind of absurd figures. This is fine. This is media. They will just extrapolate everything. They will only show you the good times. But the fact is that investors who earn and this is from a case study, investors who earn the best returns in a volatile market are the ones who are dead, which means people who don't, who just, who keep investing and don't bother too much about churning money. Okay, I'll now move after 1 year, I'll move it from this place to this place. This will give me better returns. The market is behaving this way, so I should take out the money, I should invest. I mean, we do it sometimes, we do it on and off case, but then this is not how you're going to earn money. Who's going to earn money like this? Only a stockbroker or only your broker is going to earn money if you interact or if you transact so much with your money. Okay. And don't try to time the markets and time investments. It's a myth. Okay. Give your money time to grow. That's the vital thing. Put it in, let it grow. Keep monitoring it. Whether you want to invest a little more or stop your investments a little bit, that's fine. But don't just keep churning it around. Okay, leave this fund, go to another fund. So that's not how money is built. Okay. Okay, I'm going to skip this particular slide because of the paucity of time and move to the last section of our presentation today, which is the principles of wealth management. So this is some of this we may have already covered while discussing the wealth myths, but some would be new for you. So let's focus on that. Okay, I'm just listing down the principles. So there are a lot of them. Of course, we cannot discuss all the principles. There are tens and twenties and many principles, but we're going to discuss certain key aspects, certain key principles, which we may not have discussed till now, or which are having a significant impact on your wealth generation. Okay. First thing is to get started. That's the biggest problem that people have. We all come in, listen to a presentation, read a book, get excited, and then leave it there for the next book. Okay, we don't really take any action. Okay, my advice to people who read books or get into such kind of seminars or presentations or webinars: take one thing out of that book or that presentation, just one thing, and go and implement that. Because if you don't do that, then everything was a waste. You might remember it someday, but then you've lost the time. Time is vital. So take one thing out. You don't have to take 100 things. I'm going to talk about 100 things, but whatever impacts you the most, take that one thing and make a decision that I'm going to implement it from today. If you don't get started, you're not going to reach anywhere. Okay. So it's not too early. It's not too late. It's just perfect time to get started right now. Okay. after the session, go and implement it. Even if it means going back to your parents, if you're from college, going back to your parents, asking for your pocket money, taking out a percentage out of it, going to the bank, getting your account open, and investing it there. Do that effort. It's worth it. Okay. Starting early, we talked about starting early, does why it really time when I say it's a big lever is because there is a magical thing called as compounding, which we're going to discuss next. And a lot of you know compounding. I know everybody knows compounding, what it is. And even school students know compounding. But we all know it. That's it. We have never ever appreciated the magic of compounding. Never. And I just pray that you realize how powerful it is. And then, if you realize how powerful it is, you will start saving every single rupee because you have realized how powerful it is. And that difference I cannot inculcate in you. If I just push you, okay, save every rupee, you will say, oh, forget it. This is not how I want to live my life, that every rupee I save. But once you realize the power behind compounding, you might just start doing it. Okay, so we're going to come on that. And for compounding to work, it works in combination with time, okay, and creates a massive impact. So starting early becomes important. Before we go to compounding, we're going to talk about the aspects, the levers which most people know of in terms of how money can be grown. And there are four levers. Mostly we focus on the first lever and not focus on the other levers. So it's important for me to show you. The first lever is, of course, your income. And income can come from your salary, rental incomes, your businesses, and other areas. And most of us focus here. Okay, we spend most of our time generating more income, which is important, but not the most important. Okay, and then the other lever is taxes. We try to save taxes from by doing a lot of investments and various ways to save taxes. We try to minimize them. So we try to increase our income. We try to reduce our taxes. That's what we make an attempt to do. And then we spend money for various things in life, and those are your monthly expenses, which could be grocery bills, education, fuel, insurance, and so many other aspects. So we try to minimize them as well. But the biggest lever to wealth generation is not increasing your income or reducing your taxes or reducing your expenses. They are all important. But the biggest lever to generate massive wealth is look at what you have saved and do something about it. Okay, you got to look at out of 100 rupees you earned, if you have saved 10, what I can do with that 10 rupees? How can I invest it for better returns? How can I invest it to lead a better life? How can I invest it to prevent certain risks coming onto me? So on and so forth. So that's the key where you should be focusing on. Of course, you got to first focus on your income, but then don't. I've seen people just keep earning huge amount of money and then they just don't know where their money is lying. Lot of people discover their assets while on the journey to financial. Yeah, they discover they've forgotten. Their money is lying somewhere they don't know. They're not aware. Then suddenly something when we push them harder, or create a list of your assets and so on, then they suddenly realize, oh, I have this 2 lakhs kept there. I had forgotten about it. So that's what the problem is. You are earning, but you've forgotten what to do with that saved money. Okay. And that's the biggest of the four levers which are going to really help you. So I'm going to give you this very simple example just to emphasize on this point which I just talked about. So there's a guy, let's say Rohit, and his income is 80,000 rupees a month. His expenses are 40,000 rupees a month. And he also has an accumulated corpus over last 10 years, 15 years of 20 years of working. He's accumulated around 2 crores and his portfolio is giving around 6% returns. Now he has a situation in front of him. Where should he focus more? Should he focus on getting a salary increase? Even if we assume he's going to get, let's say, 15% hike after he's put in his best efforts. So that's one option in front of him. Other option is try to get better returns from his portfolio. Maybe 1 or 2% better returns. Not that from 6% he can reach to 12% or anything like that. What is better? Where should he focus? What's going to give him better returns? And as I told you in the last slide, the fourth lever comes pitching in here. If he focuses on option A and works very hard for his increment, and he actually gets an increment, let's say a 15% increment, which would mean essentially an increase of 1.5 lakhs per year because he was earning 80,000 per month. And but for that, he has to obviously continue putting in 8 hours per day effort. Plus, for getting an increment, he might have to really slog. But if it focused on option B, where his average returns was 6%, and if we can improve it by 2% by focusing on that, his increment per year is 4 lakhs, not 1.5, but 4 lakhs, more than 3 times the increment he would have got. And remember, the increment he would have got, the expectation would have been that he would work even harder next time. But here, there's no such expectation. So he's got 2% better with 1 hour a day effort. What effort he researched it, investigated it, invested his assets better, and that's how he spent an hour a day to investigate, and that's how the returns he got. So you got to understand that it's a big lever of your saved money. You got to really make use of it. You can't just ignore it. You can't just focus on earning more always. You got to focus on things that are going to be bigger levers than earning. Okay, so that's that principle you should remember. There's a lot of power in your earned money. Okay, make use of that power. Okay, one more principle which I'm going to talk about is the power of compounding. And as I said, that this is something which is perhaps the most underestimated principle. Even if I talk through it today, I'm not sure if everybody would realize its power. It hits you someday. Someday it's going to hit you. It hit me. I know if some of you have read my book on financial freedom. There was one particular moment when it hit me. I have been an engineering student. I have done all mathematics, everything. I never realized its power. But someday, it just took 1 second to hit. After it hit, my entire life changed. Okay, so I hope it hits you today, or maybe some other day whenever it's good for you. Okay, so I'm going to ask you this question. Which one is a better option on the 30th day of month one? I give you 1 crore on the first day itself. Okay, so it's, let's say, June, 1st of June, I give you 1 crore rupees. And you do whatever investments you want to do, whatever you want to do with that 1 crore. And after 30 days, we'll see what balance you have. Okay. Other option is I just give you 1 rupee on first day, 2 rupees on second day, 4 rupees on third day, and so on till the 30th day. That's it. After that, I stop giving. So which is the better option? And without really going into the mathematics of it, which you can of course go and you can calculate, you would appreciate that even if I invested that 1 crore which I got in option A, the first day of the month, I would have ended up with, let's say, 1% higher amount at the end of the month, because even if I invest in for 10% or 12% returns, it'll be 1% per month. So I'll get 1.01 crores. That's what I'll end up with. But if I selected option B, I'll end up with 2.38 crores. Now, this comes as a surprise to a few people because we're talking about 1 rupee on day one, 2 rupees on day two, 4 rupees on day three, and so on and so forth. And that's not enough. There's nothing comparable to 1 crore. But I end up with 2.38 crores because what we're not appreciating is we're just looking at the numbers 1, 2, 4, but we're not appreciating the rate at which they're growing. That's where compounding comes in. It's difficult. I mean, it's very easy to actually miss compounding, the power of compounding. Very easy, and that's why it's missed. And that's why you may never really appreciate it. But it's so powerful that perhaps one of the biggest scientists of our generation or previous generation mentioned this compounding as the eighth wonder of the world. Albert Einstein, that is. So it's pretty powerful. I'll just leave you with one example here again for compounding. Let's take a sheet of paper and fold it 50 times. Some of my readers may have heard this example. It's there in the book as well, but it's very important for me to, re-emphasize to people who have not read it. Okay. Take a sheet of paper, fold it 50 times. I mean, after 2-3 times, you might feel that it's becoming difficult to fold, but then imagine that you're able to fold it. Okay. What's the approximate thickness you'll get after 50 folds? Okay. Normal sheet of paper, it could be from a copy register, wherever. Okay. You will have your own wild guesses, but let me share the answer with you. The thickness of a plain sheet of paper, an average sheet of paper, after 50 folds, just 50 folds, is 1,125 lakh kilometers. Don't believe me. Please don't believe me. This is why this is so powerful. You calculate it. Okay, don't believe, you don't have to believe me. But there's the magic. The magic does not stop here on the 50th fold. What happens if you do one more fold? It just doubles. So whatever you achieved in 50 folds can be achieved in just one more fold. Okay? So that is the power. The longer time you give, I mean, one is multiplication of money, but the longer time you give, it becomes more and more magical, astronomical. Okay. I just hope you have try certain calculations, try a few things, read it on the internet, do whatever. Try, explore it more. It's so powerful that you will start appreciating even 1 rupee today. It can become, if you give that 1 rupee time to grow, it can become humongous. And Bill Gates, I don't know, not Bill Gates, but I think Warren Buffett only once said that your single rupee or a single dollar is the stepping stone for the next million. You got to value it. You can't just be casual about it. Okay, so that's the power. Okay, we talked about pay yourself first, which basically means saving first and spending later. So paying yourself first before you pay any billing companies, before you pay any EMIs, before you pay anything else, shopping, restaurant, movies, you start paying yourself first, and you'll become rich. Okay, and we talked about it. Compounding plus starting early is a deadly combination. This is what you should be aiming, and we are talking to you at this stage of life, so you have that early advantage you already have, provided you start. Now, if you appreciate compounding, this can become a deadly combination, and you'll have so much wealth, it will become difficult for you to manage that wealth. You will need wealth managers you need to hire wealth managers to actually manage it, because the money will start flowing in. And when it starts flowing in, you got to manage it properly. Otherwise, it can be chaotic. So, okay, I'm going to skip this considering the time constraint again. And remember this, you are the CEO, your assets are your employees. So what happens? You got to first understand what's an asset. Okay. Uh, don't invest in a liability assuming it's an asset, because a lot of people do that mistake also. Okay. Once you've understood what is an asset, you have to remember that your asset is earning for you. It's like your employee. Okay. You are in a business, you are the CEO. Your asset is earning money for you. Okay. It's working hard for you. You go to monitor. So what happens in a company? A CEO would every year or every 6 months come, okay, and take an assessment of everyone. Okay, how is everyone performing? And give a rating to it, and then what does it do with underperformers? Typically, a CEO, what will you do with underperformers? Give them a notice and check them off if they don't improve. So what do you do with the performance of your asset? First, monitor it. If they're underperforming, improve on it. If they don't improve, forget them. Deploy new assets. Come out of them. It's very simple. But you got to understand this principle that you are the CEO, your assets are your employees. You have to churn your assets which are consistently underperforming, okay, with new assets. Again, not churn everything here and there, but just which are consistent underperformance you got to churn. And keep adding more assets every day. Every rupee is important. Just remember, it's working for you. It is earning for you. It is important. Put it in an asset. Every rupee counts. Don't get casual about it. It's an awesome principle of compounding. Again, going to work here. Behave like a CEO. Every employee is important in your organization. Even the PN is important. So every rupee becomes important. Okay, you got to value it. You got to make it work for you, and that's how you're going to grow as a CEO or as an organization. Okay, so I think I'm going to skip this particular principle because this is slightly at a level higher than college level. So I'm going to kind of end the talk somewhere here before ending. Of course, I want to summarize a few things, whichever we have learned today, and then we'll open it up to Q&A. So you get freedom only if you have amassed both time and money, and you do it at the right energy level. Okay, don't wait for you to become 60, 70 years before you have both time and money. You got to achieve it early. Okay. Dash earns more money for you when you're financially free. What earns more money for you when you're financially free? Your money. Okay. You don't have to earn. If you're earning, good, bonus, but you don't have to earn. Okay. Then you need dash to become wealthy and financially free. What do you need? No financial knowledge. What do you need is a vision, a dream, certain goals, discipline, commitment. This is all we are demanding from you. And look at all the rich, look at all the wealthy. They had this discipline, commitment, goals, dreams. Okay, this is what is needed. They were not certified financial planners or anything like that. None of them, the richest of them. Okay, then it takes some money and what to make a lot of money and time. Okay, so it takes money and a lot of time, so that compounding can play its impact. Income minus dash is dash. So income minus savings first, okay, is your expenses. So you decide your expenses after you have saved money. The most powerful and yet the most underestimated and misunderstood wealth management principle, we talked a lot about it, compounding. Okay, the power of compounding is just too power, and I just pray to God you get it somehow. Okay, you might feel that you understood it, but once it kicks in, it's just too powerful. Okay, then the most powerful fourth lever is increasing your ROI. Okay, by managing your money assets well. Okay, wealth protection is also important. We didn't discuss here because again it's a big topic, needs a separate discussion, because once you've accumulated enough wealth, you've reached a tipping point, you got to protect it as well. It's like having a lot of money and you don't have a guard to protect it. Okay, so it's like a guard, you need protection. Okay, it's not what you earn that makes you rich, it's what you save and invest that makes you rich. There are a lot of people who earn a lot of money, they are bankrupt. They can, if they stop earning for 1 month, it's very difficult for them to survive. So don't forget about what's the earning part. I mean, it's important, but what's more important is to save and invest. Okay, all the best. These are my links, which of course I think Pawanji can also share. You can go to our website. You can send us an email. You can look at our blog articles and so on and so forth. There's a lot of people who are already connected with us. So I think we'll open it up for questions. Dr. Pawan.
Yeah, sure, sure. A big thanks before we move on to the question for this wonderful session. Though things look simple and they look familiar, but then definitely when you realize and implement them, they are going to make a difference to people's life. And I also think that we have, since the audiences, most of the audiences are our students, it's a very, very right time for them to understand these things and appreciate and implement them in their life. So thank you very much. Now I'll move on to a question. We have actually a couple of them. So let me start moderating one by one. This is by Abhishek. Can you suggest some investment options or plans for students who have, say, limited amount of money to invest at the beginning?
Yeah, I think for students, I would say the first investment is go and, I mean, first of all, have a bank account. I mean, that's the very basic, because students usually get pocket money and they kind of get it in cash and they use it and then they kind of spend it and then it just goes off like that. First thing is to have a bank account. Whatever pocket money you get, start putting a percentage of it in your bank account. Even just putting your money in a bank account starts earning money for you, because your savings account also gets certain interest. Okay, that's the basic thing that you can do. Then the next investment you can go for, once you have enough money. Once you have enough money means, okay, you have at least 4 5,000 rupees in your bank account. Then you start creating fixed deposits out of them. Again, very basic. Okay, and very basic and very safe and can be done online. There's absolutely no need to really keep visiting your bank and so on and so forth. You can book online, redeem online, everything can be done. Okay, and if you have a little bit of purpose in life, if you have a little bit of energy to do these kind of things, go, and if you're above 18 years, go and open a PPF account. PPF is Public Provident Fund. It is one of the best investments you will ever do in your life. If you start at a young age, gives you very good returns, government owned, no risk, tax free returns, no challenge at all if you're above 18 years. Okay, so I think this is what you should start with. Then, of course, as you grow along, your knowledge increases. Then you can look at various other options like starting with a debt-based mutual fund, very simple mutual fund, which is very safe, and so on. Then move higher to mutual funds and stocks.
Okay. Okay. Yeah. So that's the starting point which they can have. Next question is by Jalaj Arora. So he says, "Dear sir, understanding the value of money, people having great skill are not able to earn that much money which they are capable of. What is your lookout in this situation? What steps does that person need to take when he can land so that he can land a great job?" I think this is more about earning potential, how one can get an opportunity where he can make maximum out of his potential.
Yeah, I mean, see, what you're saying, people having great skill set are not able to earn that much. That's probably because they're not in an area of their interest, or probably in a stream which is itself is not favored in the industry. What's your lookout at to this situation, and what steps person you see? You don't take steps just to land on a great job, because a job is great only for a few years, I would say at best. You go to take steps to pursue your passion area. Okay, great job for you if it means high earning or a relaxed job and a high earning job or a government job. I don't know what is a great job for you. For me, a great job is, even if it is paying moderate, I'm really enjoying it, I'm learning new things in a job, it's a great job for me. So you got to from the beginning get into your area of interest. Okay, don't fall after what everybody is going into. Don't fall after what is paying you the maximum. Don't fall after where in jobs where maximum companies are coming from. That's not what you're going to enjoy, and if you're not going to enjoy, you're going to fall. You may land up in it, you may start earning big, but then when you spend a couple of years, you'll realize you're falling behind. So landing up in a great job essentially means landing up in your area of passion. That's my definition of it. So
Okay.
focus on that.
Next question is Dr. Gyanendra Singh. He wants to know, how do you choose where to invest? Real estate, gold, stocks, mutual funds, FDs. How do you compare the investment options?
Yeah. So it's like there is no it's not that one person has to go for a particular option, the other person has to go for a second option. So a portfolio needs to be balanced with various kinds of investment, like you talked about gold and let's say mutual funds and so on, because different times and different cycles lead to different kind of assets growing. For example, when stock market is typically falling, gold is rising. They always work in invert, always. And if you need a balanced portfolio, you will need to have some component of both. Okay, now if you are depending on various factors, like depending on your age group and risk capability, for you, I may go for more of mutual funds and less of gold. For somebody who is totally risk averse, somebody who panics when he sees the markets falling, then for such a person, I may not go for mutual funds at all. I may just go for debt funds, or I may go for gold or fixed deposits and so on. So it's very, very customized. So there is nothing like a good investment. There is always a good investment for a particular person. So it's very, very person dependent. And that's why in our program that we do a lot of study about the person first. What is the money is earning? What is his risk? What is his thinking about risk? What is his capacity to take risk? So we do a lot of study, and then we come to a conclusion. This is how his or her portfolio should be structured: 20% in mutual fund equity, 20% in debt, 10% in FD, 5% in gold. So we structure that according to the person's needs.
Okay, the risk profile and the ROI expected out of it.
Yeah.
Next question, sir, is by Aditya Venkat. So I think this topic I read in the book also. We have not touched it in the presentation, so it's a good question to ask. So, sir, if we purchase assets such as land and keep it for some time, and of course they will appreciate over a period of time. However, it is not generating a regular cash flow. So, what do you think of these kind of assets? So, returning ROI assets versus cash flow assets.
Yeah. So again, as I said, every investment is person dependent. So there are certain investments which are done for long term. For example, even if you're, real estate is something which you understand, it's always long term. But a lot of people get confused when I say, okay, mutual funds, for example, or stocks. Now, when you get into this kind of investments, this is always long term. This is at least 7 years. You have to forget. I mean, it is possible that we may withdraw it after 3 years if the situation, pushes us to do. But you have to forget that money for 7, 8 years, because in a volatile market, this is a typical life cycle of a equity market. So you got to forget for 7 years. It's a long term investment. If you do not have any long term goals coming in the near future, for example, if I have to invest today, and if my daughter's college admission is coming in the next 2 years, I would never go for equity mutual fund investment today. Okay, because I know I'll need that money after 2 years, and markets may be pretty down after 2 years. I cannot predict. So 7 years is a cycle. So I know I'll earn enough in 7 years. So I will not go for it if my goal horizons are short term. So a lot depends again on the person and his or her goals. If the goals are short, have a short term demand of money, then don't go for long term investment, or go partially for long term and keep the balance for your goals. So we have to, it's there's no ready made solution. Solution has to be built based on the needs of the person.
Okay. Uh, this question again is relevant to many students, as we have encouraged them to start saving at the immediate time, to write in the education when they are in. So this question is: I have a big education loan with a moderate paying job. How can I save and invest under this pressure? Many would
Yeah.
have that kind of combination.
so so you started your life from a negative net worth, I would say, because you have a big education loan already. So of course, it'll be difficult for you to invest till you have this loan with you. My advice in such cases is, of course, loan becomes a priority, because not only usually you pay higher interest on that. It's always on your head that you have to settle it. You have to settle it. So loan always becomes a priority, but do not just keep settling the loan and not invest anything. I would say, out of whatever you can save through your moderate earnings, as you mentioned, if you're saving, let's say, 1,000 rupees, just as an example to demonstrate, I would say put 800 rupees for your loan settlement, and put those 200 rupees for your investments. Why I'm saying that is because when you see your investments grow, that's a very beautiful feeling. Okay, when you see your money earn more money for you, that's a beautiful feeling. So while technically it is always better to settle the loan first and then start investing, but my experience has been people who have uh, invested a little bit and then settle the loan with the major amount, but a small minor amount they have invested, they always feel better. And when you feel better, you do better things in life. So that's how I would advise. Put it 80-20. That's how I would say.
That's very interesting. Okay, next question is by Dr. Rajesh. So thanks Manojji for the nice talk. What is the right age to teach children about saving money or financial management? And maybe I'll just add a half from my side. Would you suggest any ways of doing it? How do we start teaching children about money if you already have some suggestions?
Okay, that's a very wonderful question, because that touches the chord of a younger generation, and that's very important. Um, I think we touched on in some part of the slide, you have to start teaching them when they know how to count. And typically they would know it. Count means add, subtract, divide, multiply, and they would know it when they're in fourth or fifth standard. Typically, what I have done with my children, I can share that the moment they know that, get their bank accounts open. Of course, you will be the guardian; they will be under guardian. But once you've got that open, you give them whatever pocket money. You give them even 100 rupees. Tell them that okay, if you save 20 rupees, this will go in the bank, and after that, get a bank statement printed someday, show it to them, tell them that you invested 20 rupees, but bank has given you 2 rupees. Okay, these are very small things, but they will start questioning you. That will start getting into their mind that their money is getting automatically generated from somewhere. But you have to show them. Okay, you have to show them the interest being credited. You have to show them the statement that now you have 50 rupees in your bank account. You have to show them how compounding works, that on the same rupees, last time bank gave you 2 rupees, this time they give you 2 rupees 50 paise. So they're giving you more than what they gave last time. So if you invest it for a longer time, they'll give you even more. So these aspects can be built by just looking at a bank account statement and showing it to them, and then let them ask questions. I mean, of course they'll have a lot of questions. So that's how I did it for my children when they were growing up. I mean, now of course my children are above eight. One of my daughters is above 18, and she has her independent bank account. But then, so I think that's the key. So start as early as you can, probably in fourth or fifth standard.
Okay. Okay. Next question is by Mr. Sandeep. So his one half of the question was, I'm 35, am I too late? Second half of the question is, what best options can I have at this age to start? Like what are the A, B, C, D milestones? Where do we start?
So first of all, 35, you're not late, because I also started at 35. Today I'm, of course, I mean, I took financial freedom when I was 42. I started at 35, so it took me 7 years to get financially free. Today I'm 47, touching 47. So I've spent last 5 years into a beautiful world. So if you're 35, you're just at the right age, Rajesh. And I mean, the whole point is life is never lived looking backwards. Whether am I late or early is not the point. You're always right on time. Okay, life has to be lived, moving ahead, always. And I don't know, many of you know that. I keep repeating this story. It's a story of Milkha Singh, who lost his position for an Olympic medal just because of one thing, and that was he looked back. Okay, he looked at his companion runner, and that just slowed him a little bit, and that was the difference. If you go to run, you got to look forward. You cannot be saying, looking back and saying, okay, I missed the chance early. If I had started at 25, this would have happened, and so on. That's meaningless. Life is always moving forward. And what kind of investments? Of course, I mean, again, we'll have to study your profile, study your needs coming up, and then decide what kind of investment. Of course, it's going to be a combination of a lot of different asset types. It could be a combination of fixed deposits, mutual funds, debt funds, stocks, real estate, everything it could be. So it depends on a lot of about your profile. So no fixed answer to that. It will depend on you.
Okay. Okay. Fair. Next question is around compounding. So we have actually a couple of questions. So I would appreciate if you can spend about a minute or two more on explaining how compounding can actually add to the journey of financial freedom and how it works, maybe in more simple terms.
For compound, see, financial freedom is all about reaching a particular tipping point and doing it fast, because we want to do it at an age where we can really enjoy that money also. Okay, so compounding is one of the levers that help you multiply your money faster. Okay, there are many levers we talked about. Compounding is one of them, and in fact, one of the biggest ones of them. So for that, you have to give time to your money, and you have to keep putting in money. So if you're saving 500 rupees also as a student, you have to start early. You have to keep saving it, keep putting it in, and compounding will not. You will not see any meaningful results from compounding in the first 5 years, 7 years, 10 years. It will only start churning in magic after 10, 12, 15 years. And the magic will be so huge that you will not be able to believe yourself. It's a simple formula of compounding, but again, not appreciated and realized by most people. You can try it out yourself. We looked at a couple of examples during the slides as well. So that's how magical it is. So you got to start early for that and continuously keep investing money for compounding to work after 10 years. It's a long term thing. It has a delayed gratification. There is no immediate result of compounding.
Okay. Next question is more specific rather, by Ashutosh. So he wants to know more about cryptocurrencies as an investment. If you would like to share, if you have any idea.
Yeah, personally, I don't recommend cryptocurrency to anyone because it's very technical, and not that we cannot understand it, but technology changes too fast. Okay, and I prefer to avoid it. In India, I mean, still, of course, it's not legalized in the way that you can really start using cryptocurrency for your day-to-day needs. So personally, I would currently prefer that you avoid it. Um, when investing, the one of the golden rules is you got to first look at stability of your investment, then look at returns. Normally, we run after high returns, but what if you lose the principal? Okay, one wrong investment, just one wrong investment can ruin your 10 good investments. So that's very important to understand. Okay, so in the lure of high returns, just don't get it. If you totally understand it, if you're technically completely aware of how it works inside outside, I don't mind you giving it a shot with some percentage of your money. But I don't really understand it to that level of depth, and I won't recommend it to anyone today. Because I first look at stability of my principal amount, then only I look at ROI.
Right. Uh, though we always say we should never try to time the market, but still the greed kicks in. The next question is around that: is it a right time to buy stocks when they are so down?
Yeah, if you understand this stock market, then any time is the right time. I mean, you are asking this question probably because uh, markets have been down over the last few months because of various situations worldwide. Although the markets have already picked up quite a bit in India, so that advantage which we were thinking, that's not really there now. But timing, when I say people try to time the market kind of every week, that's what I'm saying should not never be done. Uh, when this COVID crisis came, and I mean, a couple of months back when it really started coming into India, that time when the markets immediately fell by 20-30%, and that time we also advised to all our people who are in our program, elite program, we also advised them to start a 3-month top up SIP is a systematic investment plan on mutual funds. So we advise them so that to take advantage of this sudden rare event that is happening. Such kind of events happen once in 10 years. Okay, that's when you can time a little bit good, no problem. But if you're timing it every week or every month in a normal market, that's what should be avoided. So timing and getting into mutual funds is fine in such rare occasions like COVID. And the last it happened was during the global financial crisis around 10, 11 years back. Okay, so these times it's fine to do a bit of timing, but otherwise no.
Right. Next question is around stocks versus mutual funds. So there are 2-3 questions around that. So how someone decides which way to go, to directly buy stocks or to go for a mutual fund?
See, from a returns perspective, of course, stock market, direct stock investments have a higher potential to give you returns. There's no doubt about that. But you also need a lot of knowledge before you invest in stock. You need to do certain analysis. You need to be aware about the company. You need to be aware about their business. When you're investing in a stock, you are investing in a company. You're buying a company, basically. You're buying a part of the company. So imagine that if you were to buy, let's say, TCS today, if you were to buy it, how much of study would you need to do? Or if you were to buy any other company which you trying to invest in. So stocks need a lot of study, and of course the return potential is much higher. But if you've never been into the market, you have to of course start with mutual funds first, because many people fail in handling the leak in the volatility of the market. You know, when you invest, I mean, most people before entering into mutual funds or stocks, they have been used to investing in fixed deposits, banks, and PPFs and EPFs, and where you see continuously your money is continuously moving up, linear. Hmm? When you come to mutual funds and stocks, for the first time, your money is not linear. Okay, your money goes up and it goes down next day. Okay, and it's minus 20% after 1 month, and then a lot of people start panicking. Stock market is more volatile, much more volatile than mutual fund investments. So I would say if you have not ever invested into these things, start with mutual funds, take experience of volatility for next 2 years, then start thinking of analyzing stocks and investing in them. You have to do a proper value analysis.
Next is not a question, it's an appreciation note I would like to read by Mr. Ishtiaq. So, dear Mr. Pavan, this is Ishtiaq from Dubai. I am not a student, I am a student of Manoj sir. I have learned financial freedom at the age of 45. I just want to thank you and Manoj sir. But very importantly, I would like to pass this message to your student that they are very lucky and fortunate to have this opportunity of enlightenment at this age. They should take it very seriously and a very important education. So thank you very much, Sir Ishtiaq. We definitely appreciate your note and definitely a session by Manoj sir. Coming on to the closure of the session and the last question, it's a little philosophical and I wanted to end on this note. So this is by Dr. Javed Khan. Thanks for enlightening talk on financial freedom. I really liked the explanation about graph on free time versus money. Do we have a similar graph for happiness versus money?
Yeah, we do have. Actually, we do have. I may not have it in this slideshow, but I don't mind sending it to you. We do have a graph on that as well. A very interesting question. Well, I always believe, money. I mean, we have been talking all about money in this presentation, but believe me, it's just a piece of paper unless you link it to your life and happiness in your life. And that's a very, very good question. And I think from next time, I would include that graph in our regular financial freedom
It
slides
can be
as
a
well.
good closure of the session.
Yeah,
Yeah.
absolutely, absolutely. I'll send it to you, but
Sure. I'll share it. I'll share it with Dr. Javed. Yeah. Last question, which has just come up. Maybe we can take it. It's by Pankaj. Is it okay to spend money on term plans?
oh yes. So, man, I mean, if you have generated some amount of money, I think we talked in the last slide which we displayed about wealth protection. Okay, so you have generated a lot of money, but now you need to protect it also. It's not only that you have to manage it by growing the money. Growth is one part of it, but you have to protect it also. It's like you live in a posh area, you live in a posh house, you'll always have a guard there. So term plan is like a guard for your money. And by the way, term plan is the only plan you should be buying, and you should definitely be buying. It gives you a lot of peace of mind that your money is safe, in the sense that even if something happens to you, your family doesn't need to bother about paying your EMIs or liabilities and all the stuff. So wealth is kind of protected. Otherwise, what will happen if you accumulated 40 lakhs and you had a 50 lakh EMI going on? Then if something happens to you, then your family will just give away all that 40 lakhs paying for that 50 lakh liability, right? And pay additionally 10 lakhs. And if you were protected by a term plan, your 40 lakhs is protected. Nothing happens to that. Okay, your EMI is taken care of by your term plan, which is the money which will be payable to you on execution of the term plan. So term plan is one of the best guards that you can have for your wealth that you've created. So when you've created a wealth, you're working hard to make it grow. Spend some time and money to protect it as well.
Sure. On this note, we would like to move towards closing this session, but it was really very, very enlightening and learning opportunity for all of us. And I definitely hope that this would prove to be a milestone in the lives of our students and would give them a upstart in terms of their financial and professional planning. And definitely, if we meet them after 20 years, 30 years, maybe some of them would acknowledge the importance of this session, which they would have felt by that
No,
time.
I
And
really want to thank you, Dr. Pawan, and everybody else who organized this. And I just hope that people who get even a single message out of this entire discussion go out, achieve freedom, and do something beautiful for the world around us. Do something for our society, and you will be able to do it only once you're financially free and taken care of your family needs. So go out, do make a difference, create an impact in this world. That's how the money needs to be used. Don't just keep accumulating. So that's how I would take it. Okay.
yeah, definitely, definitely. A big thanks to you for sparing time and joining us. Though it was a little longer than usual webinars, but I think every minute of it was worth it. And we definitely look forward to having more such sessions for our students and staff.
Thank you so much for organizing it, and very well done. Thank you.
Thank you,
Bye bye.
everyone. Have a nice day.